economy is fundamentally different today than it was yesterday. The system of global trade anchored on the United States that Canada has relied on since the end of the Second World War, a system that, while not perfect, has helped to deliver prosperity for our country for decades, is over. Our old relationship of steadily deepening integration with the United States is over. The 80-year period when the United States embraced the mantle of global economic leadership, when it forged alliances rooted in trust and mutual respect, and championed the free and open exchange of goods and services, is over.
A huge change just rocked the energy market. Canada, a major gas supplier to the United States, and Qatar, a key global player, shifted their exports to Europe. Gas that once flowed to American buyers now heads across the Atlantic. This isn't a small adjustment, it's a tariff-driven pivot that's shaking up trade worldwide. The United States leaned on Canada for most of its gas imports, worth billions yearly, keeping fuel steady. Qatar sent plenty to America too. Now Europe's getting the bulk, with new deals signed fast. U.S. tariffs, adding costs to gas trades, pushed this move. Quiet talk sealed it, leaving markets stunned. Gas prices in America edged toward $5, and jobs are wobbling. Europe's factories and homes now tap this redirected supply while U.S. buyers hunt for options. From Canada's fields to Qatar's plants, trade routes are shifting, driven by big money and new plans. Why did these two turn away? Tariffs sparked it, but there's more to unpack. Canada's changing course. U.S. tariffs, charging extra on gas exports, cut into profits, so Canada looked elsewhere. A massive new project in British Columbia pumps out millions of tons of gas yearly. Instead of crossing the border, most now ship to Europe, places like Germany, and Asia, like Japan. The shift's clear. Canada used to send tons of gas to the United States, but that's down sharply now. Europe has signed billion-dollar deals for a big chunk, driven by their need for steady fuel. They pay better than the United States, where tariffs drop margins. Canada's pipelines now feed ports built for overseas trade, not American buyers. This makes sense. Tariffs cost Canada millions, while Europe's demand, after losing other suppliers, promises more cash. The United States still gets some gas, but it's not the focus anymore. Longer-term contracts lock in Europe's share. Canada's chasing better markets. What drove this pivot so fast? The answer's tied to trade costs, and it's reshaping energy flows. Qatar's rise in the global gas market is putting real pressure on American exporters. With new production coming online, Qatar is offering competitive prices and flexible contracts, which honestly appeals to buyers worldwide. Meanwhile, America is facing tighter margins and more competition for buyers, especially as Canada and Qatar both ramp up their exports. This changing landscape is forcing American producers to rethink their strategies, and it's, well, reshaping the entire energy market dynamic. Qatar's making moves. Its giant gas fields churn out millions of tons yearly, up from recent years. Europe's the main target now. Germany locked in huge contracts. Italy followed, and more are in talks. Qatar's gas meets a critical need, filling gaps in Europe's supply. The numbers add up. Qatar's gas is cheaper than U.S. options, especially with tariffs hiking American costs. Europe's desperate for reliable fuel after losing other sources, and Qatar delivers without trade hassles. Last year, the U.S. got a solid share. Now Europe takes way more, with Qatar's exports climbing. This isn't just about supply. Qatar's deals stretch years ahead, tying up Europe's markets. Their fields could produce even more soon, outpacing rivals. It's a planned push to lead gas trade. Qatar's not just selling fuel, it's gaining ground. Why focus so hard on Europe? There's a bigger strategy here, and it's shifting global markets. So, America's feeling the squeeze. Gas exports to Europe have dropped as Canada and Qatar sent, millions of tons elsewhere. U.S. terminals, which were once buzzing, now run slower, and that's costing thousands of jobs in places like Texas. The fallout, well, it's hitting wallets all across the country. Gas prices are up, nearing $5 a gallon as supplies tighten. Canada's exports to the U.S. fell, forcing more reliance on those pricier domestic fields. Factories that process gas are facing higher costs, and they're passing those on to shoppers. Groceries and bills are creeping up, and smaller businesses are struggling. The U.S. counted on Canada's steady flow and Qatar's extras. Europe's new contracts worth billions are locking those supplies away, leaving America to compete in much tougher markets. Gas isn't just fuel, it's jobs and prices. And honestly, the stakes are growing. Why did suppliers pivot? Tariffs changed the game, but the US is paying a steep price. And, well, there's more to figure out. Tariffs and trade policies really shape the global energy landscape, often in ways that are, well, unexpected. When governments impose new fees or restrictions, it can shift the flow of goods, change who buys from whom, and even upend long-standing partnerships. These realities force countries and companies to rethink their strategies, always looking for the best deal in a constantly changing market. Tariffs turned things upside down. The United States added fees on Canadian goods, including gas, making deals less profitable. Qatar faced similar pressures. Both found better buyers in Europe and Asia, where prices beat tariff-hit United States markets. The impact's sharp. Canada's gas exports to America shrank, losing millions in value. Qatar's shipments swung to Europe, where billion-dollar deals now rule. Europe pays more than the United States, where tariffs cut into earnings. Canada even taxed United States goods back, leveling the field. This wasn't a fluke. U.S. tariffs aimed to shape trade, but they pushed suppliers away. Europe's need for gas lined up perfectly, and secret talks moved fast. Something feels off. Did the U.S. misjudge the fallout? Tariffs don't just cost money, they redirect trade. Canada and Qatar followed the cash, and the U.S. is left sorting out a new reality. Europe's energy market is shifting. Losing a major supplier left a massive gap. Hundreds of billions of cubic meters gone. U.S. gas helped before, but now Qatar and Canada are filling it. Germany relies on Qatar for a big chunk, while Canada supplies places like the Netherlands. The deals are huge. Billions in contracts tie Europe to Qatar's fields and Canada's projects. Some last a decade, showing serious commitment. But there's risk. Qatar's supply depends on calm markets, and Canada's pipelines face pushback from local groups. Europe had to act fast. With demand for gas staying high, they couldn't wait. The United States still sends some, but it's less now, and honestly, it's pricier. Qatar and Canada offer better rates and a steadier flow, so they're winning the contracts. Europe's betting on new sources. How did Qatar and Canada step in so quickly? It's more than just need. There's a plan behind it. So here's the thing. Canada and Qatar really saw an opportunity and moved quickly. With Europe searching for reliable suppliers, Qatar used its massive reserves and existing infrastructure to ramp up deliveries. Meanwhile, Canada, with its abundant resources, started shipping more gas overseas, not just to Europe but to Asia as well. Both countries are now shaping the global gas market, building influence, and making a lot of money along the way. Canada's seeing green. New gas deals with Europe, worth billions, bring in serious money. Asia's buying too, like Japan, pushing Canada's gas earnings higher than ever. Coastal towns are thriving, with thousands of new jobs from pipelines to ports. The numbers work. U.S. tariffs slashed profits on American deals, but Europe and Asia pay better. Canada's exports shifted less to the U.S., more across oceans. A big project in British Columbia pumps out gas for these new markets, with plans to grow even bigger. This isn't just luck. Canada's pipelines are built for global trade now. Not just the U.S. future deals could lock in Europe for decades. The U.S. still buys some gas, but Canada's focused on richer buyers. Gas isn't just fuel, it's growth. Why go all in on Europe? Tariffs tip the scales and Canada's making the most of it. Qatar's influence is growing. Supplying a big slice of Europe's gas makes them a key player. Their fields could pump out even more soon, topping other suppliers. But it's not just fuel. Qatar's building trade ties that reach further, from ports to new deals. So, Europe's contracts open doors. Countries like Italy, they're talking billions in trade beyond just gas, like shipping projects. And, Asia's noticing. Deals with places like Japan are picking up. These links aren't just about energy, they're about shaping markets, and Qatar's gaining fast. The plan's sharp. Cheap gas gives Qatar an edge, but trade talks build bigger wins. Europe's huge demand hands them leverage. Other countries want in too. What's Qatar aiming for long-term? Qatar's rewriting trade rules. Their gas deals started it, but the bigger picture came into focus, and it's not just about pumps. Now America faces a new reality. The global energy game is shifting and options are narrowing. As Qatar and Europe build stronger ties, the United States has to rethink its own strategies. It's not just about competing on price anymore. It's about influence, partnerships, and, well, adapting to a world where old rules don't always apply. The United States isn't down yet. Losing Canada and Qatar's gas hurts, but there are options. Domestic fields, like shale deposits, could ramp up, though. Honestly, it's costly. Exports to Europe fell, so Asia's markets, like South Korea, look tempting, despite some pretty stiff competition. Gas prices at $5 sting, and thousands of jobs are gone. Factories pay more for fuel, pushing up costs for everyone. But new tech could lower drilling costs soon, adding supply. Smaller deals with other countries might help, though they're pricier than Canada's old rates. The shift caught America off guard. Tariffs meant to steer trade sent gas elsewhere, and now buyers face tighter budgets. Still, the United States has gas to sell. It's about finding the right markets. Adapt or struggle. That's the choice. Why did tariffs backfire so hard? The United States is digging for answers, and time's ticking. The gas market's different now. Qatar's billion-dollar deals lock in Europe, boosting their trade clout. Canada's new contracts add thousands of jobs, fueling growth. Europe gets steady gas, but leaning on Qatar and Canada could mean trouble if supplies wobble. Prices might jump. The United States took a hit. Exports shrank, costs rose, and jobs vanished. Gas at $5 hurts, but there's room to pivot. Asia could buy more if deals line up. Canada's pipelines face delays, and Qatar's fields aren't risk-free. Everyone's playing a high-stakes game. This goes beyond fuel. Qatar and Canada grabbed a chance, while the United States recalibrated. Trade's about who moves fastest, and new leaders are stepping up. Is there a hidden angle to this shift? Gas rewrites the rules. Qatar and Canada are winning now, but markets never stay still, and the next twist is coming. So Europe is placing a huge bet on both Qatar and Canada right now. Their gas, really we're talking about millions of tons every single year, keeps European factories humming and homes nice and warm. These billion-dollar deals are supposed to guarantee a steady supply, but honestly, it's not a perfect system. If global trade hits a rough patch, Qatar's supply could suddenly falter. And over in Canada, well, their projects sometimes run into delays because of local disputes. Europe's all in on Qatar and Canada. Their gas, millions of tons yearly, keeps factories running and homes warm. Billion-dollar deals ensure steady flow, but it's not perfect. Qatar's supply could falter if global trade gets messy, and Canada's projects hit snags from local disputes. The payoff's big. Europe cut its dependence on other sources, and prices are stable, for now. Qatar's cheap rates and Canada's reliability beat U.S. options, which cost more after tariffs. But if one supplier stumbles, Europe might face shortages, spiking costs across the board. This wasn't just about fuel. Europe needed partners fast, and, Qatar and Canada delivered. The United States lost ground, unable to match the deals. So what's the catch? Can Europe trust this new setup? Risks loom, but so do gains. Europe's gas bet is bold, and it's really changing how trade flows, with surprises still possible. Canada's not just a neighbor anymore. Gas deals with Europe and Asia, worth billions, have put it on the world stage. Projects pumping out millions of tons yearly aim for buyers far beyond America. Towns near gas fields are growing, with new jobs and cash flowing in. The United States tariffs pushed Canada to diversify. Europe pays better, and Asia's demand just keeps rising. Exports to the United States dropped, but global markets more than make up for it. Canada's planning bigger projects, eyeing decades of trade with new partners. So this shift is definitely strategic. Canada's pipelines and ports, they're built for the long haul, not just for those short U.S. routes. The U.S. still buys gas, sure, but it's honestly a much smaller piece now. You might wonder, why go global so quickly? Well, Canada is really seizing the moment here. Tariffs opened the door and they're just running right through it, building a gas trade that's honestly hard to ignore. For the United States, this is a real turning point. The landscape is changing, and the decisions made now will shape the future of energy, for both countries and for the world. As Canada looks outward, the U.S. faces new choices and new challenges. The story of North American energy is far from over. In fact, it's just entering a whole new chapter. America's at a turning point. Its own gas fields could grow, but scaling up takes years. Cutting tariffs might bring Canada's supply back, but, those talks just drag on. Qatar's deals with Europe are locked tight, and Asia's markets are, well, pretty crowded. Gas prices might hit $6 if nothing changes. Qatar could grab even more of Europe's demand, and Canada's exports just keep climbing. The United States needs new buyers, maybe Japan or perhaps better tech to cut costs. Tariffs meant to lead trade pushed gas away, and now families pay more at the pump. Is there a way to pivot? Options exist, but honestly, they're tough.